What is going on, traders? Welcome back to Atlas Options channel. In this video we'll talk about the bear flag chart pattern and how to use it in trading. The bear flag chart pattern is a technical analysis pattern that can be used to identify potential short trades during a downtrend in the price of an asset. The pattern is characterized by a period of consolidation, or sideways trading that forms a flag shape, followed by a continuation of the downtrend. To identify and trade a bear flag pattern, you need to first look for a clear downtrend in the price of the asset. This downtrend should have a series of lower highs and lower lows. Next, you need to look for a consolidation phase forming a flag shape. This consolidation phase should have a narrow range of price movement and last for at least a few days. During this phase, the price should move in a parallel channel or slightly downward sloping channel. To confirm the bear flag pattern, you need to identify the flag pole, which is the initial sharp decline that precedes the consolidation phase. The flag pole and the flag should form a right-angled triangle, and the slope of the flag should be in the opposite direction to the slope of the flagpole. To measure the potential price target for the bear flag pattern, you can take the height of the flagpole and project it downward from the point where the price breaks out of the flag pattern. This gives you an estimate of the minimum distance the price could move lower. Once you have identified a bear flag pattern, you can enter a short position on the asset. You should set a stop loss order above the flag pattern to limit potential losses, in case the price breaks out of the pattern. As the trade progresses, you should monitor the price action to see if it follows the expected pattern. If the price breaks above the flag pattern, it may signal a continuation of the uptrend, and you should exit the trade. If the price continues to move lower, you may want to adjust your stop loss order to lock in profits, or move it down to limit potential losses. In summary, the bear flag chart pattern is a useful tool for identifying potential short trades during a downtrend. By looking for a consolidation phase forming a flag shape, measuring the potential price target, and using proper risk management techniques, traders can potentially profit from falling prices. However, it's important to note that the bear flag pattern is not always a reliable indicator of a continuation of the downtrend, and traders should consider other technical and fundamental factors before making a trading decision. For example, traders may look at volume levels, momentum indicators, and news or events that may affect the asset's price. Additionally, it's important to manage risk appropriately and not rely solely on the bear flag pattern as a trading signal. Now you know how to spot the bear flag pattern on the chart and how to trade it. To solidify your knowledge, go through the charts, try to find this pattern, and see how the price action played out. This practical exercise will definitely improve your trading skills. If you find this material useful, please give it a like, make sure you get subscribed, hit notification bell to stay up to date. Also make sure you check out the links in description to support the channel. And I'll catch you in the next one. Take care.